Living completely free and clear off dividends is the goal all dividend investors have in common. And I think it's safe to say that many dividend investors find themselves tempted investing into higher than normal yielding stocks or ETFs because of how much more dividend income these higher yielding ETFs and stocks produce. But unfortunately, many times these higher yielding stocks and ETFs are not the best choice, as they are often associated with things like declining share price, unstable business models, or even future dividend cuts. But in this video, we are going to go through what might be a perfect strategy for dividend growth investors that don't want to wait years and years and years to see any substantial dividend income, but also favor capital appreciation and total return on top of that. Now we are going to go through all this and more right after you please drop a like in this video and subscribe for more content like this in the future. So when it comes to dividend investing, finding the perfect strategy that combines income generation and capital appreciation is the goal that many investors strive for. And it's a goal that's easier said than done at times. The strategy that we are going to be exploring in this video is going to be combining two very popular ETFs known as JEPQ and SCHD. And by combining these two ETFs, this could offer a very well-rounded strategy for dividend growth investors that want the best of both worlds. And this is because JEPQ, on one hand, is ideal for income generation. JEPQ's dividend yield is around 10% over the last trailing 12 months. While SCHD focuses on dividends, of course, but also a heavy amount of capital appreciation, at least historically. And by combining these two ETFs, investors can achieve a well-rounded portfolio that offers stability and growth potential. Sound good yet? So this strategy in theory would make the portfolio 50% JEPQ and 50% SCHD. Once again, in order to generate a large amount of dividend income on a consistent basis, but also 50% SCHD in order to have massive capital appreciation long term. Let's first take a look into JEPQ and see what the fund has to offer. JEPQ is designed to provide current income while maintaining prospects for capital appreciation. So this fund's goal is to pay income on a monthly basis, but also hopefully see some capital appreciation on top of that. Now JEPQ generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream from associated option premium and of course stock dividends. So just like jepi. So far, once again, for the investors out there that are familiar with the JEPI, the jepi ETF, you're probably asking yourselves right now, well, at this point, what's the difference between jepi and JEPQ? Because as you know, when it comes to the jepi ETF, that fund also seeks income and capital appreciation by selling options and of course getting paid dividends. But stay tuned because we are going to go through the differences and they're very, very important. As of May 31st this year, the yield is 10.75%, which is interestingly enough surprisingly higher than JEPQ's brother, which has a 30-day SEC yield of 8.48% only. But looking a little bit deeper into the JEPQ ETF, so the fund was started back in May of 2022, so it hasn't been around all that long, which for me personally as an investor is definitely a red flag. I try my best to not invest into things, at least not a significant amount of money, into stocks or ETFs that haven't been around for a while. Even though historical performance doesn't mean that a stock or ETF is going to perform the same way in the future, it does give me a little bit of peace of mind when I see a fund or a stock that has a long-term solid historical performance. But with JEPQ only being around for just around a year now, we don't have all that much data to go off of, although so far it's done pretty well, which you'll see in a second here. Now maybe one of the most important aspects of JEPQ, especially when you compare it to jepi, is the underlying holdings. The stocks and assets that the funds hold are significantly different. Now if you look right here with JEPQ for example, the holding breakdowns are technology almost 50%, communication 16.27%, consumer cyclical 15%, healthcare 6%, consumer defensive 5%. Industrials 3, utilities 1, financials 1, real estate, and energy less than 1. With the top few holdings being things like Microsoft, Apple, Alphabet, Amazon. And look at the amount of the overall fund that these few holdings make up of the entire fund. These are big pieces of the entire fund made up of just a few of the top growth names throughout the markets. Now this was definitely interesting to me because if you look at something like jepi, the JP Morgan Equity Premium Income ETF, JEPI, you can see that technology does make up a decent amount of the breakdown, but only 16.91%. Healthcare being 13, industrials being 13, consumer defensive being 13, financials being 12, consumer cyclical being 9, utilities being 5, communications being 4, real estate, basic material, and energy being around 3. And also the top 10 holdings in JEPI are much more well diversified, being that any given name doesn't make up of more than 2% of the overall fund. Where once again back here at JEPQ, you can see that something like Microsoft, Apple, and Alphabet, just those 3 names make up of well over 25% of the entire fund. So what does that necessarily mean for JEPQ? And what does that mean for this fund overall? Well, because JEPQ does invest very heavily in the NASDAQ, very heavily in growth names, and with a large emphasis on piling a large amount of cash just on a few of some of the most popular growth names in the entire market, you are likely going to see bigger swings to the upside and the downside when it comes to investing to JEPQ compared to JEPI. Now, that doesn't necessarily mean that's a bad thing. Volatility or higher beta either way doesn't necessarily mean it's bad. But it is important for investors to understand the underlying holdings are definitely going to change how JEPQ is going to trade in the future, especially for investors like myself that have been holding onto something like JEPI for a while. JEPQ is a whole nother beast. Now, another important comparison from JEPQ to JEPI is JEPQ has $3.4 billion in assets under management, which is significant and pretty impressive for a fund that's been around just around a year. Now, JEPI, for example, has $26.63 billion in assets under management. So it's only a matter of time until JEPQ probably gets up somewhere close to this, if I were to guess, but at this time, JEPI is much bigger than JEPQ still. Next, let's look into JEPQ's dividends and what it's paid out since the fund's inception. So JEPQ's last dividend was announced on the 1st of June, and it's only 36 cents. Now, I say only because in the past months, JEPQ has paid out things like 48 cents, 45 cents, 43 cents, 44 cents, and before then, JEPQ was paying out 58 cents in the month of December last year, 55 in the month of November, and even 68 cents in the month of October. So of course, a lot like any other covered call fund, JEPQ, along with JEPI, along with qyld, all these different covered call funds are going to pay out a different dividend on a monthly basis, depending on what happens in the market during that specific time frame. Next, let's take a look into SCHD, which would be the other half of the fund. Again, SCHD does offer a dividend, but also some massive capital appreciation and massive dividend growth. Now, SCHD has been around since 2011, and this ETF tracks the Dow Jones US Dividend 100 Index and invests in companies that consistently pay and exhibit sustainable dividend growth. SCHD focuses on quality companies with strong financials and competitive advantages. And with SCHD's low expense ratio and attractive starting dividend yield, SCHD is a very compelling choice for dividend growth investors seeking reliable income on a quarterly basis and also the potential for some massive capital appreciation. Now, SCHD is currently up around 175+% as far as on the all-time chart, which shows that even though this ETF offers a very decent, in my opinion, dividend yield, there has been substantial capital appreciation over the last 10 years or so. Now, SCHD is also heavily diversified, which a lot of us long-term investors love. And this ETF's top 10 holdings are companies like Broadcom, Pepsi, the Home Depot, Merck, Cisco, Coca-Cola, Texas Instruments, Chevron, Pfizer, and Verizon. Like I said a second ago, SCHD has a very cheap expense ratio of just 0.06%, which is definitely an expense ratio cheap enough, even for a very frugal investor like myself. Now we get to the good part, SCHD's dividend and dividend growth history. This is what most of the SCHD dividend investors absolutely love. So the ETF currently has a trailing 12-month dividend yield of 3.68%, which definitely offers investors a decent amount of cash flow pretty much right out the gate, an annual payout trailing 12-month of $2.64 per share. And as far as SCHD's quarterly payouts, since the fund's inception, they have not missed a payout, and they've mostly, for the most part, only went up into the right direction, which long-term dividend growth investors definitely love to see. Now, looking a little bit further into the Schwab US Dividend Equity ETF's dividends and the dividend growth rate, which is basically how fast they've grown their dividends over time and how fast they possibly could grow their dividends in the future. SCHD has a 3-year dividend growth rate of 14.05%, which is very, very impressive. A 5-year dividend growth rate of 12.24%, and a 10-year dividend growth rate of 11.35%. So pretty much at any time frame, SCHD has grown their dividend quite fast, at least historically speaking. Now, what's pretty cool is with this program, we could see the future dividends for SCHD long into the future. Now, of course, these are just estimations, but with the current 10.03% dividend growth rate, which is somewhere of around what SCHD has done in the past, we could see, again, potentially, just an estimation, $7.33 per share as far as a dividend paid on a yearly basis from SCHD if and only the dividend growth was to continue on like it had been. So by combining a well-rounded ETF like SCHD and a little bit newer ETF JEPQ, investors in theory could definitely benefit from the best of both worlds as far as capital appreciation and a steady flow of dividend income on a consistent basis. Now, of course, this strategy is not the only strategy like this. There's lots of investors, including myself, that build their portfolios pretty much mocking the same thing, having a portion of the portfolio being low yield and higher growth, and a portion of the portfolio being a little bit less growth but higher yield, gives dividend growth investors like myself an overall quality portfolio that not only pays me on a consistent basis, but also has capital appreciation, which means the portfolio is going to be worth more, hopefully, long term. But I want to hear what you guys think down below as far as the perfect strategy for a dividend growth investor that's not only seeking large amounts of dividend income, but also capital appreciation. If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.